We've got another one, another extreme, and this one comes from Switzerland. It's actually a pair of them, starting with the Swiss franc, which soared to a 14-year high, which then greatly raises the chances the Swiss National Bank ends up at negative interest rates all over again, and in the not too distant future. We are seeing way too many of these extremes. They are becoming entirely too common. This isn't trouble for the dollar. It's a critical Eurodollar warning for the entire world. To that end, the IMF also earlier today slashed its growth projections for the entire global economy with an emphasis on the United States and Europe. The soaring franc, for one thing, is a reflection of those growing dangers in both of those places. And I don't mean the world is ditching the dollar. That's not happening no matter how many times the usual suspects say it is. Setting that ignorance over reserve currencies aside, there really is a serious alarm in the franc's performance that we need to be aware of. And it's just another one reaching these extreme levels like copper to gold, gold to silver, swap spreads, and others. These really are just different sides of the same Eurodollar coin, the kinds of alarms that are consistent with a global economy facing increasingly dark prospects and interest rates that end up at exceptionally low levels and for a lot longer. Remember, the Swiss had started the race to the bottom among central banks last year, warning the rest of them worldwide were going to follow, not because of tariffs, rather because the global situation was fragile and getting to be more so. And that's just what has happened. So pay attention to these Swiss alarms. The world isn't ditching the dollar. These exchange values, especially the extreme ones, are the Eurodollar system warning about the same thing the IMF is, if not going well beyond the IMF, like we see in Switzerland. The Swiss franc goes up against the dollar. That is a risk-off, risk-aversion signal. Not about the dollar and the currency and the rest of the world using it. It is instead about the Eurodollar condition and what that means for everyone inside as well as especially outside of Switzerland. As of yesterday, the Swiss franc, another extreme value. It hit its highest level since August of 2011, which is a big clue because of what was going on in August of 2011. The exchange value was almost 0.8 to the US dollar. And another big clue, it was 0.8819 back on April 2nd. So you're talking about an absolutely huge move in a short period of time. And when we see the Swiss franc move this much, this quickly, that's not about ditching the dollar. It's about safe haven flows into Switzerland based on fears of the global economic condition as well as particularly Europe's place in it. For all these people who are saying that the Swiss franc or the euro are replacing the dollar's reserve currency, the Swiss franc is telling you most of the fears are manifesting on the European part of the system, which goes along with everything that we've been saying over the last couple of months as far as what European banks themselves have been doing. I've pointed out each time, January and February, how European banks are buying near record amounts of government bonds, preparing for something. And that something is exactly what's priced into the Swiss franc that is soaring not just against the dollar, but also against the euro. The franc rises against the dollar when the Eurodollar is experiencing all of these issues. Between, for example, June 2010 and August 2011, when the Swiss franc was soaring back then, it went from 1.16 to the dollar to 0.73. Huge increase in the Swiss franc as the so-called European sovereign debt crisis, which was really Eurodollar number 2, a global banking crisis funding in US dollars based on European sovereign debt collateral that was being rejected. Eurodollar number 2, Swiss franc goes higher. European focus of the Eurodollar problem. And even more recently, you go back to Eurodollar number 4 in 2019. The Swiss franc was largely stable, and we'll get to a reason why in just a minute here, but the Swiss franc was largely stable throughout the middle part of the 2010s. It was down around 1.02 to the US dollar in May of 2019, but from there, as global recession signals, pre-COVID recession signals, were increasingly difficult to ignore, and they were stronger and stronger, especially in Europe, the Swiss franc began to rise all over again, despite the fact the Swiss National Bank at that time was already deeply in negative rates and had been consistently in negative rates for many years by then. Remember, during late 2019, it was the Europeans who restarted QE because they were seeing the same types of negative possibilities that all those piling into the Swiss franc were at the same time. And then after the 2020 crisis, the pandemic, after reaching a high of 0.878 to the US dollar in January of 2021, the Swiss franc fell back against the dollar and the euro during the reflationary period 2021 and 2022. By November of 2022, the Swiss franc was all the way back at 1.01 again, which was its lowest exchange value since May of 2019 when all of that stuff began. But since November of 2022, the Swiss franc has been stronger again. Why? The forgot how to grow economy. November 2022 is not some random coincidence. That's when the arrival of the forgot how to grow economy really started to make a difference. And where was the forgot how to grow economy the most prominent? In Europe. So the Swiss franc was a reflection of the fact that the European economy forgot most how to grow since late 2022. Now, the franc hasn't been up in a straight line since then. Obviously, it's been back and forth and extremely volatile. But that kind of volatility, like in the euro during these crisis periods, that's another sign of disorder in the monetary system. Fragility, increasing concerns about the consequences of fragility. So this is not the world ditching the dollar, no matter how many times you're going to hear that over, as long as the Swiss franc continues to go higher, as the euro continues to be volatile, or the Japanese yen. In fact, I did a video about this just a couple weeks ago, back on April 12th, talking about this very topic and how clearly it is to debunk the idea that the world is ditching the dollar. These signals from these currency exchange values are incredibly important, and they have nothing to do with moving away from US dollar or US dollar assets. When the Swiss franc goes up, as I pointed out in that video, it is during periods where we see clear crisis conditions in the Eurodollar system and the economic consequences that go along with them. In fact, those two things go hand in hand. When the economy is increasingly shaky and fragile, the monetary system is going to look the same way. And it feeds back into the economy, which feeds back into the monetary system, which feeds into the Swiss franc and other currencies going higher against the dollar. And every time everyone says they're ditching the dollar, but that's not what this signal is about. It's an incredibly important Eurodollar signal that suggests that monetary conditions as a reflection of global economic and financial perspectives are becoming increasingly difficult. So while DXY, because the Swiss franc is a pretty substantial allocation of DXY, along with the yen and the euro that accounts for 75% of DXY, while DXY is going down because of the Swiss franc, because of the Japanese yen, the carry trade there, because of the euro being volatile, DXY goes down, but the dollar against other currencies is far from weak and far from falling. If you look at something like the Federal Reserve's Emerging Market Currency Index, what you see is that the dollar against these emerging market currencies hit a record cumulative high on April 9th when the entire world was being liquidated and melting down, again displaying the characteristics of a rising dollar, difficult funding environment, illiquidity, and tightening all over the Eurodollar world. And why emerging market currencies? Because emerging market banks tend to be exclusively borrowers on the Eurodollar system. So there aren't other considerations. It's strictly Eurodollar funding conditions that are reflected in these currency exchange values, which tells you it's not about ditching the dollar. In fact, the dollar continues to get stronger against the very currencies that everyone says are getting rid of the US dollar. And from that record high on April 9th, at the worst of it so far, the emerging market currency index has only been down a little bit. As of this past week at 136, that's just the lowest since the middle of March. It's not something like DXY that's at a multi-year low because dollar conditions haven't changed. And dollar conditions in the Eurodollar world are what matter, not this idea that the world is replacing the dollar with what? So DXY goes down when the euro is volatile, and the euro is volatile because of these considerations, negative perceptions about the entire global system, fragility. CHF, or the Swiss franc, goes up for the same reasons. JPY goes up against the dollar, the carry trade reverse, and the carry trade reversal is driven by recession considerations to begin with. So while DXY is going down, the Swiss franc is going up. You need to pay attention to the Swiss franc, not because of DXY and the interpretation of DXY, but because the Swiss franc corroborates the risk-off approach that is deep inside the Eurodollar black hole. A good example of this that's not the franc, the euro, or the Japanese yen, China's yuan. China's yuan absolutely crashed to a near 20-year low on April 9th, around 7.35 to the dollar. But since then, the best it's been able to retrace is to 7.29. Just like the emerging market index against the US dollar, China's yuan 729 is not a strong value. And as of today, it's back down to 731.23, weak all over again. So the dollar is behaving, including the Swiss franc, exactly the way it would in these more difficult, even crisis level situations. It's another extreme value like we're seeing in the copper to gold ratio, gold to silver ratio, or most important of all, interest rate swap spreads. With the Swiss franc soaring in this way, that means the Swiss National Bank, which doesn't want to lower interest rates any more than it has already, is going to have to. And since it's already at 25 basis points or 0.25% to begin with, it's going to go to zero, and then the chances are rising. It'll go back to negative rates. In fact, Swiss National Bank officials, starting with SNB President Martin Schlegel, have said, hey, negative rates worked as far as we're concerned, so if we have to, we're going to go back to negative rates. So the stronger the Swiss franc gets because of this risk-off approach, the more likely it is the Swiss National Bank will be reacting to them with negative interest rates, thereby completing the entire cycle, which wasn't supposed to happen. This was supposed to be structurally high interest rates, structurally higher interest rates, when already the Swiss National Bank, leading this race to the bottom, shows the markets were right the entire time. Rates are going down and are likely to go down a lot and are likely to stay there for the reasons that are starting to become clearer here in the middle of 2025. What Schlegel said back in December when the Swiss National Bank voted for its 50 basis point rate cut at the time, there would be another rate cut last month in March that brought it down to 25 basis points. What he said to Bloomberg in December was,
one very important lesson is that negative interest rates worked. When we introduced the negative interest rates in 2015, it was to lower the attractiveness of the Swiss franc, and this worked with this negative interest rates. This is certainly the main takeaway from this period of negative interest rates. But it's also clear nobody likes negative interest rates. Also, the Swiss National Bank, we do not like negative interest rates. But, of course, we would also be ready to implement negative interest rates again if necessary. But with the cut that we did today, the probability of negative interest rates has been lowered.
They always claim that lower interest rates are powerful stimulus, so ultra-low rates must be even more powerful when history shows that's just never the case. They assume it's the case and they hope it's the case, but as we're seeing here once again, lower interest rates or interest rate policies are completely irrelevant or almost entirely irrelevant. So from his perspective, negative interest rates worked when the Swiss franc was too high, and now we have the Swiss franc that's too high, and therefore the chances of the Swiss National Bank reacting to the Swiss franc too high has gone way up with the franc. Now, the Swiss could also intervene directly in the currency markets by selling the franc against other currencies, but more than likely they're going to have to do probably both, but the chances for negative interest rates are going way up as a reflection of global conditions. This is a global warning. So when the Swiss franc goes up, that's the rest of the world saying risk off. And so the Swiss National Bank cuts rates because the Swiss franc is up. And so the Swiss National Bank, if it gets to zero or negative, it's because of the risk off that's happening in the rest of the world. So what the Swiss National Bank was saying last March when it warned that rates were going down was that the global economic situation was becoming increasingly fragile, and the Swiss National Bank was reacting to it, and now the franc is doing the same thing, as that fragility is not some theoretical future problem, it is right here, right now. So the franc is up as a warning, and the Swiss National Bank reacting to it, negative interest rates, also a warning for the same things. And other central banks, including the Fed, should be wise to all this because they're going to be following along just as they did last year. This is about tariffs. The race to the bottom began well before all of that started, well before tariffs even became a thing. In the middle of last year, everybody started to race to the bottom, and the Swiss were the first ones to do it. So quite fittingly, the IMF came out today with its updated World Economic Outlook, or WEO, which was a substantial downgrade from what they were expecting back in January. Back in January, they said, hey, the economy looks like it's survived its 2024 downturn and recession scare, so everything looks great in 2025. Oh, crap, it doesn't. And I love how they started out. The WEO starts out with this. Admitting that the world wasn't recovering in the past couple of years, they are basically describing the forgot how to grow economy in their own words. It starts out this way. After enduring a prolonged and unprecedented series of shocks, the global economy appeared to have stabilized with steady yet underwhelming growth rates. And in reality, it stabilized because it didn't look like it was falling into a deep contraction or recontracting all over again. It was not underwhelming. It was lack of recovery. It was the forgot how to grow. They call it underwhelming because what else are they going to say? It was really a recession, but we don't want to call it that. So even the WEO starts out, hey, the last couple of years weren't as great as we've been making it out to have been the entire time. But then continuing, the swift escalation of trade tensions and extremely high levels of policy uncertainty are expected to have a significant impact on global economic activity. That's really the fragility. Under the reference forecast that incorporates information as of April 4th, global growth is projected to drop to 2.8% in 2025 and 3% in 2026. And by the way, these are not good numbers, down from 3.3% for both years in the January 2025 update, corresponding to a cumulative downgrade of 8 percentage points and much below the historical average of 3.7%. And the historical average includes 10 years of the silent depression. So the historical average of 3.7% is already too low to begin with. And now the world is lucky if it can get to just 3% and hold it there with more risk to the downside than there are any possibility of getting to an upside recovery. But there's more. In the reference forecast, growth in advanced economies is projected to be 1.4% in 2025. And remember, these are always overly optimistic. Growth in the United States is expected to slow to 1.8%, a pace that is nearly a full percentage point lower relative to the projection in just January. And then, of course, they blame greater policy uncertainty, trade tensions, and they finally throw in some truth there, softer demand momentum, which was apparent long before we got to 2025. Whereas growth in the euro area at 0.8% is expected to slow by 0.2 percentage point. China, they got them marked down by a full percentage point too, from 5% in 2025 down to 4%. In other countries like Mexico, which is China adjacent, as well as suffering its own downturn to begin with, long before we got to 2025, Mexico, they've downgraded from 1.5% growth, what they were expecting in January for this year, to minus 0.3%. So recession in Mexico is one of the more extreme warnings of all these other economies out there. So while the IMF is mostly worried about developed world fallout, again, these are overly optimistic numbers. From forgot how to grow, downside risks are increasing, which is consistent with the franc, the Swiss National Bank's behavior, and all the markets, and even central banks that are following along, finally seeing fragility. It was never strength and resilience. It was fragile the entire time. So the world is not ditching the dollar. The dollar, in all of these different ways, weaker against the franc, stronger against emerging market currencies, is reflecting what the IMF is saying in its pretty substantial downgrade, certainly for some place like the IMF. The Swiss franc rising is not a good sign for global prospect. And the Swiss National Bank follows the Swiss franc with those prospects. And in response, any negative rates in Switzerland, what that will mean is that Switzerland is completing the race to the bottom, getting back to where it was never supposed to go. The world was never supposed to see ultra low, let alone negative interest rates. And that was done. That was the 2010s. Things were different this side of the pandemic. So as the Swiss warned last March that things were moving in the wrong direction, and I don't mean inflationary direction, over time, the rest of the central banker class has said, yeah, maybe they're onto something. And what they're onto is the same thing the markets have been warning about the whole time. Rates are going down as a reflection of fundamentals, lower growth, lower inflation, maybe even, if we're not lucky, the deflationary monetary disruptions that we're seeing in all of these extreme indications, like gold to silver, copper to gold, swap spreads, and now the Swiss franc. I went over all the details in DXY's three troublemakers, the franc, the yen, and the euro, and what they really mean in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.